What is going on, guys? Happy Sunday, February 26, 2023. We are looking at futures right now, and we are set up for a full week in the market this week. And we really broke down below a pretty key spot last week, so it's gonna be a really interesting week. I think in a lot of our eyes to see where we want to go and to see where this thing wants to head this coming week. So there's a lot to talk about. We got futures pulled up right now. S&P futures are up 0.15%, 0.16 roughly. Not that much. But then again, right, they are up a little bit here. Where here's the how we pretty much finished on Friday. This is all Friday's action with the higher volume at the bottom of our screen right here. And so we kind of had these higher lows develop. And the way we kind of finished off last week was we kind of like, at least I was mentioning, it felt kind of like we were going down generally over the course of the past 2 weeks or whatever. We've kind of been gliding, or a week and a half gliding lower, but it's like we're not getting that like stocks hitting new lows and just dumping even into further lows, people just selling the bottom and those bigger flushes. We're kind of getting some dip buyers, it seems like, with a lot of things, kind of making a new low, then catching a bid, making a low, catch a bid, and then bounce back up for a couple hours, right? And it's kind of been the theme. So we'll see if we continue to see that this week and, kind of go from there. But overall, I want to pull up big picture charts. I want to look at weekly charts, get a picture for like bigger, get a look at bigger picture trends and all that good stuff. So essentially this move right here, these two big candles down, these occurred off the PCE numbers that came out on Friday. If I jump back, PCE numbers came in, core PCE came in a little bit hotter than expected. And year over year came in at 4.7 versus a 4.4 estimate. So inflation numbers jumping up a little bit hotter, which I don't think is like super surprising. The question now I think just remains, is it a fluke? Is it a little bit a bump in the road, or are we going to have a kind of a more prolonged, higher inflation, like I guess than maybe the projections were looking a few weeks ago, right? So things are kind of shifting back towards that way. Wouldn't be surprised if we kind of find some balance in between where maybe things have gotten a little bit ahead now, and now everyone's like worrying that we're going to go to like 6.5% on the Fed funds rate. And I mean, not everyone, but we're seeing like, talks of 6 plus, potentially if inflation stays high. Wouldn't be surprised to see that kind of fall back, right? That kind of, go back and forth a little bit more, maybe fall back towards some sort of middle ground here in the next couple of months once we get some more data on that, right? So that's kind of the bigger thing that we're looking at overall. But yeah, a little bit of relief on Futes. Yeah, for now, I mean, we'll see what happens. This week we got, what do we got this week? This week, that's next week. It's not March 6th yet. Yeah, this week, the 27th is Monday. Durable goods, core, not that much. Fed speaker tomorrow at 10:30, but not a big name, so I don't think it should move much, should it? Tuesday morning, some retail inventories hold, nothing insane. Like these aren't like huge market moving things really. So it's kind of a week that's I think should be a pretty chill news week unless there's something else that comes out of nowhere. But it looks like a pretty chilled news week in terms of compared to the past couple of weeks. And then I guess going into March, as we start getting into March, then the eyes start looking at the next CPI and whatnot. 75 overnight so far, nice. I mean, this has been well, let's look at this. And it's the past couple, I guess, overnights, we've had some big moves, right? Had some nice gap ups or gap downs over the past like week. So that's why it's been like pretty interesting, because like I feel like the intraday action's been a lot choppier than the overall trend has been the past like couple of weeks or the past like week and a half. Like if you go to the 1 month chart on futures, right, you look at this and you'll say, okay, like the trend's been clearly down, but like look at all these massive like bounce backs that we had, these huge like up and downs along the way. So it's been a lot more choppy than I think the overall trends indicate, right, which have been generally down. So big picture on SPY or the S&P, let's go to SPX and pull this up and see what we got. So we technically, if you want to, I guess we can adjust this line. It's a little bit off. Let's adjust this and make sure it's like kind of going from the bottom here of that October low, connect those lows, and yeah, we did close below it. So I mean, we closed below the trend line, the uptrend line right here, right? So this would tell me that hey, like this might be a decent short opportunity unless we get back above like really you don't want to see at SPX or the S&P really, or even SPY, back above that 4 level. So 4,000 ish on the S&P and then 400 ish on SPY, give or take a little bit. You really don't want to kind of see that. If we get back over 4,000 on the S&P and 400 on SPY, and close a day or two above that, that would be kind of concerning, I guess, for bears. So we'll see, but it's been, it's been a fake out environment, I feel like, but this is a big, on the short term, at least in short term trends, but big picture, this is a bigger picture deal, right? We're not talking about, a 5-minute chart. We're talking about a daily chart here. So you'd think this has more weight. And if you go to the weekly chart, right, this looks even worse because, that Friday bounce back, right, on a weekly time scale because we were down for the week, still is a pretty bearish, I guess, weekly candle, right? Pretty nasty, pretty, fat red, not like a huge wick, a small lower wick, nothing insane. So not the best of looks, but I want to look at some weeklies though first to start us off, because I think that's like a big picture view and a good way to start things off and kind of get a framework of what we're looking at. So that's the S&P. Here's the NASDAQ. So NASDAQ, couple lower highs on these wicks right here the past couple of weeks since the late January into early February period. But right now it's kind of on the highs of November. Want to see how it handles this area. I guess you can kind of draw a zone right here if you wanted to. Would like to see what happens around this zone on the NAS. But the NASDAQ we were looking at, I think the S&P's actually been weaker than the NASDAQ and the Dow. The Dow got weak substantially this past week. Like this is a pretty big breakdown here. Like the Dow above this 34,300 level, like that's going to be a nice look to the upside on the Dow if we get there, right? But in terms of the downside now, we start to break down below this 32,560, then that's a breakdown right there on the Dow. So that's our two levels. We kind of had a big range, right? Because we kind of had this chop for about like a month or two from that lower range to the higher range of those two like lines that I have drawn in right here. And now in that chop, now we're kind of just chilling right at the bottom. So you want to see us either bounce here or we break through, then you got continuation moves maybe to the downside if it's not a fake out. So watching that, I think a good way to look or a good way to gauge this is going to be the 10-year. So here's the 10-year. Here's the past like week on the past couple months on the 10-year. And what you'll see is that, we've been solidly moving to the upside. I changed this over to solid candles. I know I like to use hollows. I don't really think it matters. I usually use hollows, but I think it's harder to see. So I figure I'll use solids. Either way, like there's a decent difference in terms of what you decipher, but at the end of the day, it's similar. It's not a massive difference. The thing with the difference is on a solid candle, reds and greens. Like you could have a red day, meaning that we're down from the prior day, but if we had upward action from open of the candle to close, it would be a green candle. That's like the only thing that's like different. Whereas the hollows just tell you if it was a red day or a green day compared to the prior close, or a red candle or a green candle compared to the prior close. So I don't know. It doesn't really matter. You can take the same general idea away, in my view. But that said, so you want to see what happens here. I think a 4% test on the 10-year would be pretty impressive. And again, this tends to lag, like the stock market tends to lag this, right? It's not a perfect correlation, but if we keep seeing this guy grinding, not going to be a great look, right, for the market. But if we start to see this thing roll over maybe a little bit, right, this week into next week or whatever, and the stock market doesn't immediately bounce, like I wouldn't be super surprised because there's a lag there. But if we start, again, if this starts to break down and start going lower, generally speaking, you can look at the stock market and maybe have more confidence in a dip buy as time goes on. That's just been the correlation for now. Again, that won't really always be the case again, because you can have a scenario where, and I think you very well can and may actually get there, where at some point maybe late this year or next year where the 10-year comes down and the market also comes down, and that would be a situation where 10-year may be pricing in a deeper recession type of deal, and then the market's pricing in worse earnings than expected and whatnot, other concerns that are happening. Maybe something happens, news-wise and whatever, and that could move things down. So they don't have to work like that, but that's been the trend, right? The higher the rates go, generally speaking, we've seen the market kind of pull. The only thing that I would say that's interesting, though, if you look back, I think I saw a stat. If you go back to June, right, the Federal Reserve has raised rates. I don't know how much, but a large chunk of the rise in rates, right, happened since like June, right? That's where they started doing a lot of 75s and whatever. The market's actually up, or at least it was up decently from that period of time. Let's see if I go back. Yeah, I mean, here's the thing, right? If you go back in time, like that June low, right, was here. Okay, markets. It's actually been, made this lower low in October, I guess, sure. But look where it's at now compared to where it was back in here, So the bulk, and this is why you kind of look at the pricing in of things, and you can't look at like, oh, higher rates necessarily like in the immediate term mean stocks go down. Not necessarily, because the market's looking ahead. It doesn't really matter. And actually, if you look at historical numbers and you look at back through history, you'll see that when the Fed actually pivots, that's when there's like an 80%, something like that, 80% correlation to like substantial downside in the stock market, shortly after that period. So, I mean, that's what's going to be interesting, right? So like if you're looking around and saying and hoping for the next like huge bear leg down, right? I would imagine that probably comes when, or that potentially has a high, it has a higher probability of happening, right? Because we can all think bullshit left and right? But the probability is what we're looking at, right? That has a higher probability of actually happening once the Fed goes, all right, we're going to start cutting rates. So we'll see. We will see. I'm running through some comments. Hope you guys are doing good on this Sunday evening. Had 4 micro buys, 3,975. Got filled time for a 5-point move. Nice. Overwhelming amount of bearish pressure. You know what? It was interesting too. Check this out. AAII. This is interesting too. I didn't think this was going to be the case, but we had a really interesting, nothing insane, but this week, right? So it's funny how things were like kind of like turning around and going more bullish, right? Essentially as the market was topping out on this recent, I guess push up and now pull back, we were topping out into early February. And what was happening? We had the most bullish percentage, lowest bearish percentage in a while, in at least from the sentiment indicator or survey or whatever. And now it goes up like, just see how fast. I think that's kind of what we're at. Like people got a little bit kind of optimistic, and then it's like everyone is easily going to go right back to the bear case, I think, in 2 seconds. So that's why I feel like we kind of run a point where I have no interest in a bias right now at all, because like you could break, like, yes, could we break down technically speaking, and this could be a lot lower? Oh yeah, sure. I could see that scenario. But other scenario is like, well, what if all of a sudden, we get a little move down and it kind of snaps right back up. We get a lower CPI, and next thing you know, we're snapping right back up and we're freaking, back over 4,200 on the S&P. Like, I can see that happening too. Again, people can jump right back. That pendulum can swing right back into bearish very, very fast. Now, what was more notable was I think a lot of people were kind of going neutral. The highest neutral percentage, I think, in a long time here that we've been seeing on the sentiment survey. So we'll see. A lot of bearish pressures. I think there really is. The only thing that I would say, and I think we've been saying a lot, is that things just take longer to play out, right? The bear case. I think the scenario of the consumer and inflation, deflation, whatever you want to call it, potential, concerns is very legitimate. The problem is that I just think it's going to happen when no one, it's going to happen later on, and everyone will kind of be like past that and believing that, okay, the consumer's never going to die and they got a soft landing here. And then all of a sudden, oh shit, it's 6 months later. Then now all of a sudden, wait a second, I got to rethink that. Like that wouldn't surprise me if something like that was happening. Don't like trading the overnight session because I've seen that, especially on like pretty small moves. But if you get like a big news release, you know what I mean? Or let's say I guess back in the times when like the whole Russia-Ukraine thing was going on, those futures sessions were pretty insane. Like those are the times where maybe you have a better edge, right? But when price action isn't super substantial, or you get a huge gap up off of like the initial open on futures, maybe that's a scenario where you can play that back to the downside. I've seen that work quite a bit, or even gap down, right? Same thing, off of no news, But when you don't get a huge move, you got to be careful, because like it is kind of trappy, and you can kind of, I've tried that in the past where I'll look at something and go, okay, like I'm going to put a stop here and take profit here, go to bed, wake up, stop got hit barely by a wick, and then it just, rips right back to the other way. And then it's like, okay, it's very, very trappy. 4K on ES might come soon. I wouldn't be surprised if that pop. Well, where are we at right now? Let's go to Futes. I'm looking at MES, but they're pretty much the same. Well, they're similar. That's a big pop right there, right? Yeah. Would imagine there's going to be something around this like 39.87 area. NEO reports this week. Let's check out that chart. Let's go to that weekly chart on NEO. I want to start the weeklies and just kind of frame us from there. Oh, that does not look good. If I look, this is the chart. This is like a classic, I guess, bear flag breakdown almost here that you're looking at potentially on NEO. Only problem is that you got earnings. Like, do you want to mess with that? Like, not really. But on the weekly chart, I mean, yeah, you got some support here for sure. But you break that, oh man, does not look good. These two white boxes on the daily chart are gaps. So we kind of filled one here. Maybe that gets filled this week or whatever after earnings, who knows. And then there's one all the way down here to like 475. It's a big ways down from here. I don't think that's, reasonable to expect that. But it is a spot to watch on NEO. I have that level drawn in. Spending too high in time of rising rates. People are really... Yeah, I think that's the thing. The whole credit, like, it seems like a perfect storm for later on. Yeah, no, it totally could be. Like, you think about that, right? And I think about from a perspective of rates being so high. Now, of course, if the bond market starts to kind of turn around, like, it could change things a bit, right? But rates being so high, not to mention another factor at play that I keep mentioning here and there, right, is the whole student loan thing, right? Because you think about that people aren't paying, like, they've had, the government's paused the federal loans, right? So when that gets, unpaused, I guess if they ever can approve the $10,000 relief, whether that happens or not, I don't think it's a massive deal, right? If they approve the $10,000 relief, right, student loan stuff, and then they go, okay, payments now begin, July, whatever. If that's the case, well, what happens? Now, all of a sudden, you got a ton of freaking people that 10K is like, okay, it's a drop in the bucket for my, 100K plus loans or whatever. Even if you had 50K plus loans, still, it's not that much. Like, you got to still pay a lot of money. Now you got a fat interest rate, like a massive interest rate on that debt. That's crippling. Like that, the loans when rates were low, much lower. Okay, right? Stupid. Looking back, I have student loans, as I've said many times, was the worst financial decision of my life. Do I regret the whole situation? Yes and no. I regret it from a financial standpoint. From everything else, I can't say I do, but from a financial standpoint, yes. If I could go back, I would absolutely not do it again. Or I would be looking at, I maybe would go with more of a cheaper approach, right? If I didn't know what I wanted to do at the time. But that's a factor. I mean, hey, picture people paying, 9, 10% rates because you got bad credit. You try to go refinance, and now you got your rate is freaking. It's gonna be pretty bad. So the whole again, I think it just takes time. It's just taken longer than maybe people would have thought, which has been the whole kind of game. But patience is gonna be interesting to see how that all plays out from a macro perspective and economically speaking. Down the road, what's going on? Kyle's in the house. Research some economic data, finding some bearish fundamentals overall. Not too interested in risk on right now. Yeah, I would agree. What should we open today and look for that buy sell liquidity? Check it right at open or before. I don't see very short-term funding buyers, but open the bears have the upper hand. Land REITs. Yeah, I'm curious to see. I'm very actually curious to see how the real estate market does. And so I guess there is some economic news on that front that's coming out right this week. Do we have stuff? Case-Shiller home price index on Tuesday. You got inventories, wholesale inventories. Not really, but I'm curious how that continues to kind of play out. TMF call. The TMF scenario at the situation, I think, is going to be patience. A very big patience play. The only problem is that, well, not the problem. I guess in looking back in hindsight, like it would maybe, I guess, what did you know, right? I don't think it's a bad thing to look at those leverage ETFs, and I don't think it's going to be a big deal in the grand scheme. I'll look at TLT because it's just like the daddy of essentially TMF. But if you look at like a TLT, right, and you say to yourself, okay, did we catch, is this a bottom right now? Is this bottom in potentially on bonds and whatever? Possibly, right? But this meantime, like we could shop around in this area for a bit. It's possible in my view, because if we do, right, it's going to be kind of this period where like now we're not sure if the Fed's going to go to 6%, if they're going to raise, they're going to do a 50 in the next meeting or two. They're going to do a couple more 25s. It's going to stay there higher longer. All this, that, and the other thing. My whole theory behind that, or thesis behind that, is that the higher that they go, the more damage they're going to do. And so the lower that things are going to go in the end. So if you can weather that storm in the next 6 to 12 months, I think it's going to pay. But again, that could be completely wrong, I guess. And the scenario where that's completely wrong is if somehow, some way, we just adapt to a super high, from a relative scale, the past couple decades or past decade or two, a super high interest rate environment, and we just kind of keep them there, and we're fine. The economy's fine, and everyone's fine, and rates can be whatever they are, and everyone, which I don't believe is going to happen. You look back through history, there's a lot of scenarios and a lot of stuff, a lot of data that would point to the rapid rise in the Fed funds rate being pretty nasty for what the economy is going to feel ultimately in the end. But again, right, that can take a little longer to play out. So we'll see. But again, from a TLT perspective, from a bond perspective, I'm see if it can break this. TOT breaks down below like $100. It's close, about another $1 or $2 to go. If it breaks down below the lows of December, that would be kind of concerning, you would think. That December low on TOT also lined up with the lows that we saw back in December on the relative lows in the S&P. See if that area holds. I think that's a decent spot to look at on the S&P 500 as well. If we are going to break down below this trend line, let's look back. Here's the weekly chart, but if we break down below this trend line, we got a lot of volume like right at this area we're at right now, but there's a little volume gap all the way down to about like 38.50, which will take you down towards, not to those absolute lows maybe necessarily, but get you close. And if you can kind of bounce or, fill in here, what would be interesting to see how we react, if we get a reaction at some point in here, and if it wants to bounce or want to flush back through. But time will tell, right? Time will tell. So we shall see. Okay, that said, let's jump through a couple things. So we look at the NASDAQ, look at the Dow. Okay, we did that. VIX, getting there. A little doji candle there on from this past week. Had decent range up, but then also had decent range, to the downside as well. So the VIX I'm not sold on yet. Yeah, it's curling off the lows, but it just can't get a nice finish, right? It can't just kind of sustain the moves. And of course, that's kind of the nature of the VIX. I get it. But that's kind of concerning, I guess, if you are looking at the VIX and wanting to play that as a hedge. Because again, we've been kind of chopping around. If we just chop around, I mentioned on Friday stream or this weekend video, I don't know when I did, but I said I got rid of the straddle because I was sitting there thinking to myself, okay, if I hold on to this straddle and we just chop for like another week or two, well, I'm going to lose another 25, 30%, of my money. Or we got to make a big move up or down. And, we had just made a decent sized move up and we had made now a decent sized move down, and like we could easily kind of bounce around for a bit. So just got rid of that for now. Take the small loss while I can before it becomes bigger. When I bought it, I originally was up on it nicely. I just didn't take the gains because I bought it on February 1st, February 2nd and 3rd. It was up like 100+%. And then I'm sitting there saying, well, I bought a March 17th expiration, so I'm going to hold on to this. Looking back, that was dumb, but you live and learn. I was saying I wanted to kind of try the strangles and the stuff like that more often. The problem is that, the thing that I'm learning more is that, hey, when you are up 100% plus, like you should be looking to take off, either the whole thing or take off the leg that's up 100%, and then the other side is house money, which would have paid huge had done that, but the SPAC momentum going to die out this week, man. I'm curious to see how smalls, right, and how that stuff holds up if we are going to pull, if this thing is going to roll right over. If we're going to roll right over on the S&P, then I am curious to see if any of that stuff kind of continues to fire up. Had some decent movers last week, though. Fed knows they just have to wait. I think they'll stay around 25. I would think that's probably the way. Let's go look at that really quick. I would 100%, well, it depends on March. I guess if March data comes in like really hot, I could see a 50. But I think they want to, Powell probably wants to go 25s throughout until they're done, and however long it takes. Like if they want to do a 25 March, May, June, July, fine. Just keep stacking the 25s. This way you're kind of not running the risk of going a little too much and then going, oh shit, we're screwed, because the job market's imploding and now we're, everything's just unraveling. It just took an extra couple months. I would imagine that they want to kind of ease us there. And if it takes the rest of this year to kind of keep slowly just trickling in rate hikes to get us to wherever we are going to ultimately end up, that's, fine. I don't think it really matters. I think that's what the Fed's kind of been hinting at. Not hinting, they've been saying that too. They don't, who cares about the size of the hike right now? It's more so where we get to in the end goal, right? But if they wait, they'll have a better chance. Yeah. No, yeah, because the problem, that's the risk now. I think, like, okay, you're looking at it, people are getting frustrated, like, for sure that, okay, it's not coming down. Like, we had a month or two now of, like, numbers not coming down as fast as people maybe wanted. Okay, like, big shit. It's not, who cares, right? In the grand scheme, it's not like things skyrocketed back up and we're, like, screwed. Like, yeah, things are going in the right direction. I'm sure that they have more data than we even get to see, right? That they know. Same thing with the whole job market situation. Like, as he talked about, the job market's not as strong as those numbers are telling you, because you're seeing a lot more people getting those secondary lower paying jobs. So the higher paying jobs are actually diminishing, and then the lower paying jobs are going up. So you're seeing the job market holding up, but realistically under the surface is actually not as strong as you think, because it's on the back of lower paying jobs, which I guess is, maybe you can view it as it's still strong, but what the reality that is like the wage inflation and all that crap, whatever you want to dive into. Like, people are just making less money, right? And that was kind of shown too in this report back last week, where you had, what was it, on Friday morning, you had consumer spending at 1.8, right, versus a 1.4 estimate, and then they had personal income here at 0.6 versus a 1.2. So essentially the gist is that, like, personal income not up as much as we thought, but spending is up more. So people are like, yeah, screw it, I'm going to spend more money because I got a credit card, you know what I mean? Or whatever, they have some money left, and whatever, they're just spending more money than they're estimating on people right now. And so I think this will correct. This will 100% correct. Don't worry. It just will take time. Again, like you were saying, when the credit cards dry up, when the limits kind of max out, you got no choice. Then you're paying freaking 30%, 25%, whatever it is on your credit card. Then you're in a tough spot. You'll stop spending money pretty quick when that occurs. Let me tell you. So, yep. TOT looks like a double top once we completed. 10-year for 4.2. Yeah, here's a 10-year. 4.2, yeah, it would be up into here. I wouldn't be surprised. I mean, it broke over the highs right here. So I wouldn't be surprised if it gets up into this area. You know, I'd be concerned for sure if it gets above that. But then again, would I be super? Not really. It's just, the reality is that this is just, I don't believe it will stay that long forever, because of the nature of the economy and the debt situation that we've got and everything. It just rates that high. It's not sustainable, number one. Number two, it can get there, it just won't stay there forever, right? So when you look at a macro scale, you know, it'd be kind of a situation where it's like, hey, if you got cash in the sidelines, it's like, I park that in TLT. If we get up there in the 10-year new highs, like, park that in TLT and, you know, catch that dividend and just kind of relax, you know, maybe sell some covered calls against it and just kind of chill for, like, you could chill maybe for 6, 12, 18 months. It's kind of the view, I would say, just to keep it, you know, without having to worry about where the stock market goes, you know? That's kind of the thing that I feel like I should do a better job, because I feel like there's other, well, whether it's commodities, whether it's bonds, like, you don't necessarily have to be a master of where the hell the stock market's going to go to be on the right side of things all the time. It just depends on what you're looking at and what you're focused on, right? If your focus right now is the bond market, then go nail the bond market. If you got a good feel for it, don't try to guess the stock market, right? If you don't really know. That's why the stock market view for me is like, hey, those dividend ETFs, like, stash those, because, like, who cares? That's just going to pay you cash flow every month. And then you're kind of getting yourself just slowly exposure over time. The lower we go, the more you want to put in, obviously, or the better, more you want to be invested in something like that. But obviously, who knows if we're going to go lower? You can't sit here and say that we're going to go to new lows guaranteed, you know? I thought I saw a funny one too. I saw a funny post on Twitter, like the whole diamond top thing. I've been seeing a lot of that stuff too, but it's like, I think people were posting like, oh, the diamond top just completed and it just came down. I'm like, it's kind of crazy. I don't think people are grasping at straws, but, like, it's just kind of like, okay, you can find a correlation, anything. You know what I was looking at? Check this out. So I want to pull this up on this because I'm curious how it would work on the S&P. So I got check out this Lux Algo, this indicator. I got like two of the indicators pulled up that I thought were interesting, that I found to be pretty interesting, right? So the idea behind this strategy is kind of a swing trade approach. And it's when we cross these red or green X's or plus signs, whatever you want to call them, when we cross them, initiating a swing long or short. So if we cross the red to the upside, would be a swing long, and if we cross the green to the downside, would be a swing short. with at least a 10-day period above or below before that cross. So if we're getting choppy action, like a bunch of wicks, I don't know, like this buy technically right in here would have been a little sketch, a lot of wicks, although maybe you would have entered here and your stop loss would have been put down below here, which I guess is fine. But my view was like, you get above this indicator, which right here is this green line, this green level, take a swing long and your stop loss goes below this blue indicator right here. Just kind of just two things I've been looking at from a swing perspective. And then you look at a 2-to-1 risk reward on that trade. And then your idea here is like, let's say you take the long here, right? Stop loss goes there, 2-to-1 risk reward would be like, would have hit, I guess, looking back. But as time goes on, you inch that stop up. So if let's say you enter this indicator like right here on that cross, you inch that stop up to the bottom of this blue line right here. Pull this up. This guy. So you kind of just, it's a momentum indicator. It's essentially just a momentum trailing stop essentially. So your entry is here, right? And eventually you would have been up so that like, yeah, if you didn't take any gains into the upside, which I'm sure you should do, and build a system around maybe systematically taking gains at, 1.5, 2, 2.5x risk reward, right? Something like that. Your trailing stop loss is now in the green. It would have just hit this past week, but you would have had, this would have been your gains. Like you would have had gains like here, right? It took you about, it was like a month and a half, 2 months to go from here to get stopped out. But it's kind of a cool indicator from a swing perspective, right? This is sometimes there's a little bit of chop, but I think you got to take this in the big picture and look for better trending environments. When we're chopping around, maybe it's not as useful. But looking at it on a big picture, daily or weekly point of view, could be kind of cool. I was messing around with it, and I thought it was interesting, to say the least. So something if on the weekly chart, different story maybe, but I was looking on the daily, and it was working nicely, I guess, for crypto as well. If you go to Bitcoin, BTC, check us out. Bitcoin, let me go Bitcoin, USD, Coinbase. Yeah, this would have pinned out nicely. So the idea here is like you're underneath the indicator, essentially these red plus signs. You're under the indicator. When you get a daily close above it, this was not a daily close because you only got a wick. A daily close above it, enter. So it would have been like right here, I guess, on this piece right here. Then you add, or then you just put your trailing stop underneath the blue on a long, and then that would have been nice. Obviously, looking back, great. Same thing would have happened on the downside. If you go back in time, we really crossed to the downside. You would have had massive, like for example, right back in here, and we got a clean cross from bullish to bearish, breaking down under this level right here. You would have taken a short right here. Okay, stop losses here on a swing, ride this baby down essentially for months. You would have gotten stopped out somewhere up in here, months later for a monster trade. So from a swing perspective, it's kind of cool. But there's also something to be, baked into that strategy around trending environments, non-trending environments. I don't know how choppy or how trendy we are right now. Maybe on Bitcoin, different story. It's actually looking pretty decent. But on the S&P, I think it's a little choppier. But it's kind of cool. I was kind of experimenting with this, and might be something to utilize in maybe Bitcoin or something in the future to kind of mess around with some funds like some Bitcoin or some crypto wallets and whatever that I haven't really looked at too closely. But as from Lux Algo, they reached out and I was like, oh, check them out. And it seems pretty cool. They got a lot of stuff. It's just you can make it as confusing as you want, or it can be really cool. The only problem is like, I think everyone kind of gets taken away by like the alerts. Like I don't give a shit about the alerts. I give more a shit about looking at some of the indicators. Are they useful in building a strategy that I can kind of just stick to and be like, hey, when this hits, enter, when this hits, exit, because, that's it. Just stick to it. It's an idea. So S&P Futes just got rejected a little bit right here. They're still at about 0.2% though on the S&P. Lower paying employers are cutting hours like crazy. Jeez. I'm not surprised. TOT calls or TLTW if you want to kick your feet up. Yeah, on that. Yeah, TLTW. Look, TLTW. Pull it up. Buy right strategy. So look back on this daily chart on this guy. You will see, yes, we are technically down towards the absolute, like the lows. Maybe it wants to hold a higher low here, but the general gist, right? The range on this, let's see, from low to high, just here before, was about 9%. What's the range on TLT? Because I guess in theory, you could have done it yourself, just sell the covered calls or sell calls against your position. Yeah, it's similar number, but the idea is there. And then TLT, W pays you a 19 freaking percent dividend. That's why. 9 to 20% dividend on TLTW. And then you get like a 2% on TLT. So you can get there, I think, honestly, in a similar fashion if you want to be active in selling covered calls and whatnot, or if you don't, and just let that dividend kind of do the job for you almost. So works in retail. Brutal might as well laid me off. Jeez. Hours have improved, but they're still lower. Yeah, I mean, I know from my girlfriend's work, they just kind of what they did, they just like restructured. So like they didn't fire anyone, but they essentially like restructured and were like, yeah, your job is no longer a thing anymore. So you can apply for this one or you can just not. And then like, it's kind of how that worked out for them. And I'm imagine you've seen a lot of the tech companies with layoffs and stuff like that, but would hate to be a buyer here. Doesn't make sense. No, I think that's the other problem. I think that's a good reason why the sentiment is so neutral, because people are like, I don't know. I'm like, yeah, I guess you buy the dip, but maybe not. But maybe things will be okay, and maybe we did bottom, so like you're kind of in this weird position. I feel it. That Wendy's a few weeks ago took 30 minutes to get food. There was only one customer in front of me. Dude. But yeah, you feel bad in those scenarios. It's like, people here, like, they don't want to be here either, right? But if they got no one working it, they're like, I'm just going to do my job and do it as, best I can, put a smile on my face. But there's no one else working with me. I mean, it's only be as slow as it is. It's a lot of money out there nonetheless, but why buy stocks when you can yield more elsewhere? That's my view on it too. I think so. I agree. Where you can, if you're going to play that game, then go. I like the dividend ETFs, or look at maybe the bond market, maybe other aspects where there's maybe better potential yields. Or if you're going to buy stocks, then get something with some hedges, or maybe sell covered calls. You can be a little bit active to kind of prevent your downside risk. Maybe put a small hedge on, maybe a small S&P hedge out 6 to 12 months, just so that you can kind of buy with, confidence in a way. And then maybe put out a year, buy a hedge out a year, and we get super oversold, you can take the profits on the hedge, maybe take some of those profits and toss them into some things, get a little bit of a bounce, maybe trim some off. A little more active management, I think, is going to be the key. And, we kind of talk about this, like the whole idea of like, what if we just freaking chopped for the next like couple of years? Like, what if the S&P, this chop that we're seeing right now, right? What if we just did this, to some degree over the next couple of years? Yeah, it would suck, but it wouldn't be terrible. Like at the end of the day, like it's not like you're going to destroying my wealth. Like, no, if you're somewhat invested and you're cash flowing and you're selling covered calls and you're getting dividends, like your net numbers like on longer term holdings should be going up. And especially if you can deposit money in over time, right? Your numbers should be going up. So, whether it is that or whether it's this, right? And then eventually, right, if it's that, and then eventually back up, right? Or whatever it is, if it's just a flat line before I move up and then down, whatever, like, you want to come out, the ultimate goal is to come out with more assets than you have before, right? Just keep building the pot, I would say. More companies are hiring because they became more efficient during the stimulus pump, which takes away from the lower paying jobs. Doesn't mean the last as demand dwindles. No one wants to work for fast food. Yeah, and then you see that, at least that's what you've been seeing the past, like, I don't know, a couple months, is like, well, over this past, I guess, summer, you kind of see like all these places hiring, 20 something bucks an hour, $25 an hour. At least I was seeing, like, for like places that were not very desirable spots to work, but they're paying decently and people weren't going back. Obviously now it's starting to change a little bit, but that was the case. All right, let's see a couple stocks and then, let's check a couple stocks out. Here's the weekly chart for Tesla. Pretty key spot. This is we're getting up to an area that is resistance at prior support, right? Now looking at that as a resistance, looking at this as a pretty key spot to watch on Tesla above this area. There could be some legs, don't get me wrong, up into the 230 area, 225, 230, sure. The question would be, how strong is that, and is the market going to support that? If the market doesn't support it, I'd be more skeptical of it. But then again, maybe that's just showing us there's some strength there. So key spot on Tesla this week, would not be surprised to break down, but it has been strong. So, if we were to break down and correct on Tesla a bit, back into like that 150 range, like look at this area right here, filling this volume kind of gap a little bit, like that would be a nice kind of pullback zone. Back test about half of that move as well. You made about $100 move up, pull back $50. If you want to bounce from there, cool. Like that would make some sense. On tests, Apple rejected here. Apple key spot at that's like 157.70. That's your level on Apple. I mean, above that, yeah, there's maybe some upside targets to be had, but right now you're kind of pulling back. It's in chop zone. Like you are in the middle of just heavy volume over the past like year and just choppity chop. So I'm not a huge fan. I'm more so, hey, we get down into here, okay, cool, or we get up into here, interesting, but not right now. It's like, hey, let do it. Do what it wants to do. Kind of the same deal on Microsoft in my view too. Very similar. I don't know, not very similar, but kind of a similar scenario. NVIDIA, I can't believe I saw a crap ton of posts over the weekend about how terrible NVIDIA is, or how expensive NVIDIA is. Not terrible, how expensive they are, and how they're playing off of the AI hype and whatever. Was it AI? Yeah, I guess it was AI. But how they're playing off of that hype and all this stuff. So this is going to be interesting, but the spot that I have in mind was up here on the daily chart. It's a gap to fill up to about 258 or so. If that can hit, like that would be a pretty nice upside take profit zone in my opinion. But big gap back down if it wants to break down, right? Had some good volume. And again, right, just because this thing might be expensive doesn't mean that it has to go down tomorrow, this week, next week. Maybe it does. And I was even looking at, I even saw some commentary or posts about, someone kind of suggesting this idea of like, you don't have to be right today. You got to be kind of close in the general grand scheme, right? And they were kind of essentially suggesting that you just buy NVIDIA puts right now with time, wait it out, and you'll make money. It's a guarantee. Like that's what the post kind of alluded to. And I was like, dude, I mean, like, sure, right? But the scenario here is that you're kind of teaching people again with where's the risk management? Because again, just because that seems like a good idea, like what happens if the market does rally? Well, NVIDIA has been one of the strongest stocks since, October lows. Like it's been a monster. So if we were to bounce, if we did, right, this thing could be within all-time high reach in like a friggin', month for all we know because of how strong it's been. Look what it's done. I mean, in 2023 alone, the thing has gone from, 140 to 240 almost. Like that's $100 move. Like that's pretty crazy. And $100 from here is all-time highs, pretty much. Like it's like right up an all-time high distance, and that's not even as big a percentage move. So percentage-wise, from the beginning of the year to here, it's up 69% roughly. From here to all-time highs, it's only got to go 49%, right? So it's not as unrealistic as you think. Just want to make sure if you're going to play that kind of game, you got to have, some sort of risk management in mind, right? So, and that's why I have been burnt. There's a lot of ways to get burnt. And one of the ways that I have been burnt pretty bad is when you're trying to time, like if you time it right, you're going to nail it and you're going to do very, very well. Like if you absolutely loaded the freaking boat on semis or NVIDIA back in here when everything looked kind of like a bear flag, right? Now, obviously, we didn't get the confirmation of a downtrend or a break to the downside on this move, right? But if you loaded the boat short, NVIDIA, you got crushed. Obviously, you got a stop loss, fine. If you went long into this move, right, you crushed it to start the year off, crushed, right? But the problem was like, when did you buy? If you got the timing perfectly, great. Generally speaking, if you're trying to be a contrarian on this and you're going short right now, I get it. Like we're up a lot. You get a better risk reward for like catching that relative high or low. But the problem is that the percentage, the accuracy percentage on the timing is usually extremely low from my experience. Unless you got a system or, maybe a set of indicators or something that you always look for. And like when this happens, it's a 90% because of my data that I've back tested. Great. And then there you go. But like, if you're going to kind of randomly guess, have stops in place is all I would say. Because I was the guy who didn't have stops in place, and it's not fun. You kind of add, and you get destroyed. I would love if we just chopped it. It would be funny. I think it would be funny. No, again, I think it essentially means that there's a lot of value, I think, right now, and then in the near term, maybe. Even if we go down, right? Same thing. There's a lot more value in my mind on the short-term price action, or let's say more the trading style versus the investing style, because things will become maybe more technical. You can kind of play ranges. You can play the patterns that we're seeing that are working now if you're adapting to them quickly. And then you could funnel money into, maybe a high interest savings, or just funnel money away for when the buying opportunities come for, let's say, the stocks or the sectors that you want to buy. If we do go lower, or if we chop around for, 2-3 years and, valuations kind of come down, and maybe companies can kind of live up to some of those numbers and they kind of catch up a bit, and then things kind of contract a bit, and it makes more sense in 2 years, right? The environment economically and whatever to maybe start buying these guys again. Who knows? We don't have to just go plummeting to lows, right? We can kind of chop, and that would be a scenario where people probably want to rip their eyes out. But, it wouldn't. If you're looking and you're coming in every day saying, if I'm going to get huge moves in the S&P, there's moves everywhere. There's always moves. You got to just take a piece. If you can get a piece and build a strategy to get a piece every day, week, month, then it doesn't really matter what we do if you got something to rely on. Took a 4-point move in my guy called the 10-point move. I didn't listen to my gut. Nice. Yeah, I was I had missed a futures. There was a setup, I think, was it Friday? I think it was Friday. Let's go to futures on Friday. I'll go to the 30-minute chart. I think it was price visible here on Friday 30-minute. Yeah. Here it was. Here was a spot that I would think was pretty nice if you caught some of the move down here. If you caught this breakdown, but it was at 2 a.m., right? I was sleeping at that time. If you caught that, right, we had this nice breakdown, a really nice flush into the PCE. What a huge move that would have been, from let's say 40.10 all the way down to pre-PCE. That was a 25, about a 25-point move almost. And then you could have gotten out before PCE. That's pretty cool. That was a nice one on futures, but unfortunately I was sleeping. But I've been kind of experimenting maybe with setting some stop limits, and I had one work nicely. I haven't done too many of them, where I put one on and I essentially left. I had to do something, right? I was working on something for the day or for a couple hours span of time, and I was not able to look at the screen. So I literally left, put the thing on, came back. I was like, oh yeah, the market moved down a lot. I had a limit, essentially like a stop sell, right? Whatever, it broke down below this level, get me in. And then I had immediately a take profit and a stop loss entered at the same time once that filled. So came back and I'm like, oh shit, it actually, filled on the sell, and then it filled on the cover. I locked in gains. Kind of cool. But the problem is that if I find that many times there's a little bit of, I don't want to say there's a little bit of subjectiveness, if you want to call it that, to the situation, because things can change, like volume can change, price action can change. Maybe it was respecting a previous spot, and now it's no longer doing that. So there are things like that might make you want to get out. My biggest problem, I think, has been I was too tight on the risk, and I was essentially taking a position, right, and going in and going long or short, right, doing my 2-to-1 rough idea risk reward and just leaving it, right. So we would get I kind of drew this out, I think, at some point last week. We get in, it might go a little against me, a little bit for me like this, and then it would start to do this, right, and I would let it go and do that all the way back to my original stop, when maybe I could have stopped out somewhere along the lines in here once I saw the writing on the wall. And that was something that I was kind of doing, I think, back in late last year, which is why my win rate was better than what it is now. So I'm having a lot of these things that go my way, just don't totally hit my take profit, but they get halfway there, that I let come back and do a full stop on me when there's probably maybe a break even stop, or there's probably something else that I can utilize in the meantime of a previous level of that was respecting, not respecting, something like that, a breakdown level, as a trade goes in my favor, that stop can just naturally come up because now we got a higher low, or we got this, or we got that. That makes sense, right? So that's kind of something that I've been looking to to kind of critique or add into. So there's a little bit of this of less mechanical robotic and a little bit more of like, okay, let's see how things are going, and we can act on this. We don't have to sit here and just let it do what it's going to do. I don't have a problem with the stops hitting. It's not the problem of my problem of in the past of letting a loser just become too big and go hugely against me. It's not a problem. The bag hold, there's no bag holding. Like that was a problem, I guess, back in the day. Like COVID market kind of trained a lot of people to do that in small caps, especially the bag holding mindset. That's not really a problem, I think. And I think for most people, once you get over that, you're like, oh man, that was the stupidest thing I've ever done, because there's no point. If you're going to bag hold like a SPY, position, right? Where you're just going to buy SPY and average down on SPY the rest of your freaking life. Cause looking at that in hindsight over the course of the past 50 whatever years, the market, like things have eventually come back up and you'll be fine. So, the worst it gets, you can bag hold SPY because you're not investing in like a company that's going bankrupt. Now, of course, who knows? Maybe the market's never, you look at Japan, there's a lot of examples of things going to shit, I guess. But that's at least a better historically proven method where you can have a situation like Bitcoin. I mean, not as proven maybe as the S&P and so forth, like, individual stocks, a little more risky because companies can go bankrupt, right? So there's always stuff coming in and out of the S&P too. They're always going to be, companies will move in, companies will move out. And so there's a nice diversification factor there too. NVDA, perfect picture, inverse perfect inverse head and shoulders. I mean, that you couldn't make it up, right? Like there was a beautiful setup. Now, obviously it's always great in hindsight to look back and go, yeah, it was obvious. But yeah, I mean, you got that beautiful left shoulder right there. You got the nice push down and panicky almost look down to that low right there that we saw in October. And then right shoulder pretty much came down to like the exact spot of that left shoulder and just like bounce. Let's see. I'm kind of liking using hard stops, but using general zone to stop out. Not using hard stops in general zone. Yeah, I think that's not a bad way to put it. I think the problem is that people will say, never, use a hard stop, And the problem is that when you're kind of new, the tendency is to like, oh, I'm just going to let it go a little more. Like, I'm just going to wait. Like if you have the ability to kind of say, hey, it's not working, but you can't judge that until like maybe a close of a candle or like a zone breaks or whatever, like that's fine. I think there's, I guess different levels, right? And there's different scenarios that play out and everything. All right, let's see. Let's do a couple more. Meta is an interesting spot too. Man, I again, it's kind of a huge move up, just chopping around. Just chopping back down now. I mean, get above this like 197 and then we can talk, but we're back down in here. I mean, it's just like kind of a weird spot. End phase, by the way, looks like it did hit that like 195, just took a little bit longer. And the track wasn't as perfect, I guess, as you would have hoped. But I had that short that I ended up taking a small gain on back when. But right now, I'm actually in oil shorts out for next year. So that's what I've got as my like downside plays, oil. So I'll get out of them if oil gets back above this zone. And honestly, I have stops on the actual stocks. But if oil does this, then I'll be out. Like I'm not going to hold through that. That's strength. But if oil can't get above this and we break down, they should pay decently. So that's kind of where my mind is at. But with that said, though, it is 8:30 p.m. my time. I do want to wrap things up a little bit earlier. It's kind of a chill. It's going to be a chill week. This week is my last. I'll be here this week, and then I'm going to be away a week after that for ski trip. And honestly, like I'll back a couple of days in March. Like March is going to be kind of a choppy month. I'm not going to be around very much, I feel like, throughout the month. So I'll hang out. We'll do lives when I'm home and stuff if I can. But March is kind of my month of like, I got a lot of travel and stuff planned that hopefully things work out nicely on the snow front, but it's gonna be kind of chill. So just kind of like resetting, let things kind of play out. And again, we're at a time in the market right now, in my opinion, where like there's absolutely no bias up or down. It's gonna do what it wants to do, and so we'll have to just adapt and play off what we get, and that's it. That's kind of how I see it, versus trying to guess where we're gonna go. So with that said, hope you guys have a great rest of your Sunday evening. I know it's kind of a shorter live, kind of a chill live, but we shall do more this week. We'll have Monday, Wednesday, Friday at a minimum, and I honestly might jump on. Actually, might jump on maybe like on one of the Tuesday night time frame or something like that. Maybe I'll do one even on Saturday night for all I know, because I'll be gone Sunday. So we'll see. But I appreciate you guys like always, and I will see you in the next video or stream. Take me with you. Yeah, we're gonna have a packed car driving. I'm driving home, flying to Montana, and then essentially driving across the country home with my dad and brother, and then flying back from the like almost the East Coast, like flying back. So it's gonna be a trip and a half, but should be a fun time. And I'll see you guys this week. Peace out.